Let's take a look at how the stock market closed. Record highs again for the S&P 500 and the NASDAQ. The technology names leading the way today. Apple, Microsoft, Tesla, Facebook, all higher by several percentage points. A boost to the NASDAQ, that index of 0.9% at a record high. The S&P 500 up 0.4% at a record high as well. The Dow just a little bit lower, down about 0.2% on the session. Alicia?
Of course, then we're going to stick with the major averages and have Thomas Hayes, chairman of Great Hill Capital, join us now. Thomas, want to get your thoughts on kind of the record highs that we saw at the NASDAQ, the S&P 500, the Dow kind of suffering as a result. We saw investors kind of push into tech. Why are we seeing that move into tech?
Yeah, well, Alicia, thanks for having me. As we saw, this was the fastest doubling of the S&P 500 off the pandemic lows in history. 52 all-time highs year to date in the S&P 500. And I think we saw, the move into tech today. It's as if the market doesn't believe the Fed. On Friday, they kind of announced that they want to taper, they want to take the punch bowl away. But it's like, the bar at 2 in the morning. The bartender turns on the lights, but he keeps serving the drinks. And if they're going to keep serving the drinks, then rates are going to stay low, and tech and those type of companies are going to do better. I think also the market is sniffing out the Friday jobs report, because while we did meet substantial further progress as the Fed's standard on inflation, we did not meet substantial further progress as it relates to full employment. And that's been Chair Powell's #1 priority since the beginning, is to get to full employment. We still have 8.7 million people unemployed versus 5.7 million before the pandemic. We're at 5.4% unemployment versus 3.5% before the pandemic. So as much as they say they want to get tapering underway before the end of the year, he did say it's going to be data dependent. And I think today is kind of people thinking with Delta, maybe the jobs report, maybe we're not going to add the 750,000 jobs in August due to Delta as anticipated. And as a result, maybe the announcement gets pushed from September to November. Then you're looking at a late 2021 taper or early 2022, and the bartender continues to serve drinks and the Fed continues to keep the punch bowl going.
You touch on a lot of things that I want to, kind of parse out there, from the punch bowl being taken away by the Fed, or at least the timeline for that punch bowl being taken away being outlined for us. But I want to start with that 52, the S&P 500 hitting its 52 all-time high in 2021, obviously the fastest doubling in history. That's obviously exciting for investors, but I saw your note here. You think there is some concern in store for a crash?
Yeah, you get a lot of people coming out because we've come up so aggressively off the lows, over 100% off the lows, that because of some arbitrary time mechanism, we must crash. And the fact of the matter is the yield curve is the name of the game. You're not going to get a recession until you have a yield curve inversion. We had one in August, about 6 months before the pandemic started. Historically, the market peaks around 6 to 18 months after a yield curve inversion, after the 210 spread goes to zero. And we're nowhere near that. We're steep as we've been in years. We're going to continue that steepening process even after the taper begins. And Chair Powell was distinct in his statement where he said that the two policy strategies, one is tapering and one is raising rates, are completely separate. And just because tapering ends doesn't mean rate raises will start immediately. They're a long way off, is what he said, and that implies late 2022 earliest, and more likely 2023. So I don't think we have anything to worry. Could we get a garden variety pullback of 3 or 5%? You bet. Could we get a correction of 10%? There's still a tremendous amount of liquidity in the system. It's not out of the question. But to get a recession type of crash of 20%, I think that's a long way off. There's tremendous liquidity. The yield curve is steep. Credit is just getting flowing. Credit demand is increasing on the commercial side. And I think we've got a lot of runway ahead of us for this economy.
Yeah, I think we've been hearing the calls for a correction for a really long time, yet we don't really see that. We see, days where there's a pullback here and there, but then we see days like today where we just see record highs, and there's weeks where we go, 3 days in the week where we hit record highs, whether it be on the NASDAQ, the S&P, or even the Dow. I want to stick with tapering for a moment here with you, just to get your thoughts. Do you think the Fed's timeline, as it stands right now, do you think they've got it right?
That's a great question, Alicia, because what we saw in China was, they started COVID before us, a few months before us, they had cases, and they started tightening Fed policy, their central bank policy and their liquidity about 6 months ago. And we're now seeing all of their numbers are weak, their consumer numbers, their retail numbers. They've all been coming in weak, and as a result, last week they said that they're going to increase money supply. A few weeks ago, they changed the bank reserve requirement so they could lend $154 billion more to small businesses. So they've had to reverse. In other words, they tightened too soon. They've had to reverse course. Is the Fed tightening too soon? It's hard to say. If Powell's view that much of this inflation is transitory due to supply chain bottlenecks, then they are probably tightening too soon. I think if we get into a stage where we taper slowly and we start kind of early in 2022 would make more sense than trying to cram it into 2021 and see how that goes, and then look at rate rises at around 2023. I think that's more than enough runway. So they're in the ballpark, and they should take it slowly and adjust along the way as they see the data, which I think Chair Powell has indicated he wants to do. So that's very promising. But the other thing, Alicia, that you're seeing is earnings are the name of the game. And, if you look for 2022, estimates were about $200 just a few months back. Now they're at close to $220, and we'll probably see them closer to $230 before the end of the year. So there is that fundamental growth happening that's supporting these price levels and supporting this growth, and that's very important moving forward.
Well, speaking of earnings, I want to get your kind of take on reopening stocks. Last week, we saw a kind of big boon in reopening stocks. Investors kind of optimistic there, especially with the Pfizer full FDA approval. What are your favorite reopening stocks right now?
Yeah, I think there's a couple. First off, we like Boeing. So last Thursday, we saw that the 737 MAX was approved in India. It had been grounded around the world. India is a big market. They reauthorized it to fly again. And the big one that is coming, that's in the process, would be China. And if you look at Airbus versus Boeing, basically you've got a duopoly in the business. Airbus is up 28 as of last week, about 29% year to date. Boeing was only up 3%. And a lot of that's related to the China headwind. Once that approval goes through, hopefully before the end of the year, you're going to see that divergence converge. And Boeing, we think, has serious legs over the next 12 to 18 months. We're going to see that creep back up over $300 per share in our view. So we definitely like Boeing tremendously. And then also a stock that was in the news today is Baxter International. Medical Devices is rumored to be making a $10 billion bid for Hillrom, which does hospital equipment, and it's going to be a tremendous amount of synergies moving forward for these two companies to come together. Baxter has been weak the last few months, kind of beaten down because a lot of the procedures and a lot of the doctor visits have been delayed with COVID, with now Delta. And as those procedures and doctor visits get back on the books and hospital visits get back on the books, we're going to see these businesses hockey stick. So we like that Baxter combination with Hillrom, or Baxter on its own if the deal doesn't go through with Hillrom moving forward.
Well, on the flip side of those reopening stocks, there are those stocks that obviously benefited during the pandemic. I want to get your thoughts on Zoom, but in a moment, because I think Zoom earnings have hit the tape, and I think, Kristen, you have those earnings.
I do, Alicia. Thank you. Let's take a look at Zoom, everyone. Those shares are tanking after hours. They're down close to 6% after hours, despite beating on the top and the bottom line. Here are the numbers. Earnings per share coming in at $1.36. That was 20 cents above Wall Street forecast. Wall Street was calling for earnings per share of $1.16. Now, additionally, revenue coming in at $1 billion, and the estimate on Wall Street was for $990 million. The problem here is the guidance. This company providing a whole host of guidance, and investors seemingly not so keen on that guidance because, again, investors punishing the shares after hours despite a beat in the latest quarter on the top and the bottom line. So here is the guidance. For the current period, the company sees revenue between $1 billion and $1.02 billion, sees full year revenue between $4 billion and $4.01 billion. Does see current quarter earnings per share between $1.07 and $1.08. And then it does expect a full year earnings per share to be between $4.75 and $4.79. Extremely important here as we break down this company, one that soared certainly during the initial days of the pandemic. But believe it or not, since hitting a high close to a year ago at this point, the stock, where it closed, was down about 41% from its recent high in the past 12 months. Well, with today's after-hour losses, we're down about 43% from that all-time high. So some of that momentum, a lot of that hype and growth that piled into the stock by traders has really kind of been sucked out, though many would say on Wall Street that this company does still have legs going forward. There were some questions about a seasonality factor at play here in the latest reporting period, some expectations that we would see maybe some disappointing growth numbers simply because of seasonality factors. People were ending the school year, they were going on vacation, they were able to leave their computers behind to some extent. But again, those latest quarter results actually did exceed expectations. Another metric here that we should say, the company did have about 504,900 customers with more than 10 employees at the quarter end, and that metric was actually up about 36% from the same quarter last year. So a lot of focus on this, some positive comments from the CEO that I'm seeing here in the earnings results as we take a look at them, but certainly a company that is trying to boost its global brand, with the CEO saying today we are a global brand counting over 500,000 customers with more than 10 employees, as I mentioned, which we believe positions us extremely well to support organizations and individuals as they look to reimagine work, communication, and collaboration. So the stock is down. Alicia, I'm going to send it over to you for a guest reaction.
Yeah, Kristen, we see here also the company, the Zoom founder and CEO also mentioning this is the first billion-dollar revenue quarter for the company. You pointed out a really key metric for this company, the number of customers with 10 or more employees. That was at 36% increase, but just shy of what investors were anticipating, which was around 37%. So with that, I want to bring Thomas back in if we still have him on the line, get your reaction to Zoom's report. Is this a reaction from investors on the reopening just being a little bit more of a burden than they were prepared for?
Yeah, I think, they beat on the top and bottom line, but I think the miss on the customers with 10 or more employees coming in a little bit light. When you're trading at a multiple, look, price is what you pay, value is what you get, right? And you're paying 25 times sales for this business, and you're paying 72 times next year's earnings. So you can't miss anything. And they missed on the employers with 10 or more employees. They did beat on the customers with trailing 12-month billings of 100,000. So pretty much everything backward looking was good, but people are expecting, with more and more employees going back to work in the physical office, while Zoom has built this kind of brand moat around it, less and less people are going to be using it. It will be a hybrid. They're still going to have a good business, but are they going to grow at a pace that substantiates 25 times sales and 72 times forward earnings? I don't think so. I think the growth rates extrapolated out of the pandemic are slowing materially. We saw a similar situation with Peloton. And as such, I think you got to let this stock find its level. It'll be a good business moving forward. It'll continue to grow moving forward, but I think it's going to grow at a slower pace than what we've seen when everyone was on lockdown. And we want to, get an appropriate multiple that supports the expected growth moving forward. And right now, the market is telling us we simply don't have it at these levels.
That's a great point there in terms of the multiple that it's trading at, both for sales and really just valuation, right? To your point, not hitting even by 1% is substantial in terms of investors pulling back to where the value is at this moment. I wonder, obviously, with the Delta variant being kind of still a thing on top of mind for investors, certainly a thing that we're still grappling with here in the U.S. and then globally, do any further shutdowns or even pull back in terms of the reopening, does that, mark a sign for investors to get back in and further higher the valuation?
I think it's temporary at this point, and I think the market would look through it. Maybe you'd get a day or two traders bounce. But the other thing you want to keep in mind with some of these reopening trades, like the Pelotons, like the Zooms, is that if what the Fed told us on Friday is true, and they want to pull the punch bowl away, and rates are going to go up, the long duration earnings stocks, the tech stocks that you're betting on earnings years out, those future earnings become less valuable when the discount rate goes up, the discount of future cash flows formula. So I think the market is, over the next few months, going to start to price in that taper. With rates going up, there's going to be a move back like we saw in Q1, where people are going to start to look at some of the reopening trades more aggressively again. Over the summer, they were in the kind of tech and high multiple, high growth. I think as we get to late Q3, Q4, as taper becomes more imminent, money's probably going to move away from a company like Zoom, where it requires very low rates to substantiate the multiple, and move into those cyclical and value stocks where you're paying for current earnings and people are willing to pay up in a rising rate environment.
All right, we see Zoom in the after hours again down about 8% at this moment. Beats on the top and bottom line, achieving its first quarter over $1 billion in revenue. But again, having that slight miss on a key metric for the company in terms of growth moving forward. Thomas, before I let you go here, I just want to get your quick thoughts on the month of September. Traditionally a rough month for the market, but they said the same thing about August. And we've seen some bright spots in August. What do you think for September?
Yeah, I think until the bartender turns off the lights and tells everyone to leave, I think there's a lot of liquidity in this system. Again, it never precludes a 3 or 5% pullback, but at these levels, earnings are strong. The outlook is strong. The Fed is being very cautious about how they move forward. And then we want to see the data on Friday. I mean, if you get an off-the-charts data where you get much greater than 750,000 new jobs, then the market's going to start to price in a taper much sooner, and then you could have a little bit of pullback. But if we miss that 750,000 jobs by a meaningful amount, then the market's going to say the Fed's going to be here backstopping a lot longer, and as such, the party continues. So I think a lot is going to come down to Friday's jobs report.
Yeah, Friday's going to be a big day for us, certainly, and a big day for investors. Thank you so much for your insight, Thomas Hayes, Chairman of Great Hill Capital.